Is a lot of uncertainty for investors right now. North Korea launching a missile earlier today. Drama in D.C. continues to heat up. J.P. Morgan out with a note saying the NASDAQ 100 could be headed for a pullback. So should you be worried about your money? Joining us now is Charles Bobrinskoy, Vice Chairman at Ariel Investments, and Matthew Roddy, Portfolio Manager at Rockland Trust. I'm going to start with a question that may be a little off kilter, but let me ask it anyway. Charlie, how can the markets be so zen when Washington is so not?
Well, because equities are better than a lot of the other investment alternatives. And that's just unfortunately been true for a long time. It's why stock market keeps going up. If your alternatives are a 2.3% 10-year Treasury, which is actually probably going to end up having a negative real rate of return, that makes stocks look attractive. And stocks tend to do well in a growing economy, even if it's a slowly growing economy. And that's what we've got. My words here, Matt, Charlie seems to think that fundamentals trump Trump, right?
Yeah, I mean, the fundamentals look okay when you look at earnings growth for sure. We had a great first quarter. We had a really good second quarter. I think things get a little bit more challenging from here on in. And you also look at the economic numbers, and they kind of keep coming in a little less than great. GDP today is a good example. A month ago, we were expecting something north of 3%, and it came in closer to 2.5%. So I think, you know, it gets a little harder from here. And then you add in the Washington factor and the Fed trying to reduce its balance sheet. And there's some headwinds, I believe.
Well, sorry, I was going to say, to follow up on Tyler's point, I mean, maybe we can flip it. You know, Charles, it's like D.C.'s been a disaster since, I don't know, I was 4 years old. And all the stock market does is keep going up. Do we pay too much, and by we, maybe I mean the media, do we pay too much attention to D.C.?
Well, we pay too much attention to the insignificant part of D.C. People yelling at each other, people swearing at each other. That really doesn't matter. What does matter in the end are policies. And I know this is a funny day to say this, but the general policies of those in power tend to be relatively directionally favorable for corporate America. And that's still true no matter how vulgar our president and his aides are.
Lower taxes, et cetera, is what you're talking about.
Right, exactly. And people still think, and especially regulatory reform, which really has been a foot on the neck of particularly the financial sector.
And that is indeed happening. We've seen the Congress roll back so many regulations. They don't even have to worry about the White House to do those things. But are you concerned about a delay in tax reform? Now we're talking about 2018, not 2017, it seems.
Yeah, I am a little...
I'm sorry.
Sorry, I thought that question was for me. I am a little concerned. I mean, the agenda that the administration has is really having a hard time moving forward, obviously. The lightning round of health care is moving on to probably the most important part, which is tax reform. And, you know, if they were to really struggle with corporate tax reform and personal income tax reform, if they get that far, I think that'd be a real problem for the market. I really hope that, you know, they can get probably their most important part of their agenda accomplished.
I take both of your points on this. I think it may be less what investors think the administration will be able to do, but it is more about the knowledge of what they won't do, and that is they won't take on policies that are anti-business. Let's go to some stock picks so we can leave our viewers with some ideas to put money to work. Charlie, you like a couple of asset managers, broadly speaking. Tell me why.
Because one of the big trends that's going on that everybody recognizes is massive move into index funds and ETFs. But what people miss is there's some stocks that have been left behind that can't be owned by those indexes. So my two favorites are KKR and Lazard, both of which are in partnerships formats. They can't be owned by the S&P. They can't be owned by ETFs. They're making tons of money. KKR had a spectacular quarter. It's a great business, trading at about 8 times earnings because it's not owned by the index.
And Matthew, you like an asset manager too, but of a different sort, T. Rowe Price. Why?
Yeah, T. Rowe Price is the active manager that's bucking the trend of passive, I would say. They're a proud active manager. 80% of their funds are outperforming on a 3- and 5-year basis. They're actually doing even better because they have a retirement plan business. A lot of those lifestyle and target date funds that everyone pours their money into in retirement funds, they're growing their business through that. They've got $5.4 billion in net inflows this year. The company trades at a 20% discount to the market with almost a 3% dividend yield. They just got on the Schwab and Fidelity networks, which really is going to expand their retail presence, which is, you know, that's going to be a huge avenue for them. Right. And they're spending money to get overseas. They've got a lot of growth opportunities, and they're still really cheaply priced.
Gentlemen, thank you both for the conversation. Charlie, Matt, appreciate it.
Thanks.
Thank you.
All right, well, it's Friday, and